Hi, welcome to valuationpodcast.com, a podcast and video series about all things related to business and valuation. My name is Melissa Gragg, and I'm a valuation expert and divorce mediator in St. Louis, Missouri. Today, we will discuss how to find hidden assets and or understated income in divorce cases with Leah Wietholter, a forensic accountant, certified fraud examiner, and private investigator in Tulsa, Oklahoma. How would you describe what you do as a forensic accountant in a divorce case?
Yeah, so I typically, there's 4 areas. So I typically help people find hidden assets. And then I also, like you mentioned in your intro, that we also help determining if like all of the income has been reported as part of this marital estate. And I'll kind of talk about each of these. But then also we help kind of prepare ahead of time a valuation. We don't do valuations. So we help prepare ahead of time valuation experts, especially when there's like a family owned or closely held business. We kind of find some, fun things in there. And then sometimes when there are prenup agreements or inheritance funds, we trace those funds to see whether they should be included or not included in a marital estate. So to kind of, I guess, dive down into each of those, the first thing is a lot of the times our clients want to know like what exists in the marital estate. And typically we're helping the outspouse, so the person who didn't control the finances within their marriage. And so typically we're looking at data from the last 3 to 5 years of their marriage. And they just want to know, when we go into a property settlement, is everything that's listed here, is that really what we're going to divide? Or are there things that I don't know about? And so we help them kind of go through their financial information to find those things and help them kind of bring some peace of mind to that area. And the way we do it is a little differently. So I have a degree in accounting. I have this background in accounting. I have always wanted, I started this career and stumbled into accounting because I wanted to be an FBI agent. So I worked for the FBI for a couple of years in undergrad and grad school. And so I learned to work investigations based on just using bank statement and credit card statement information and converting that into Excel and then using that information to kind of see what happened and to be able to tell that story of where did money come from and where did it go? Well, that same process, and we've really, we've taken that process and we use technology in my practice to do something that we call data sleuthing, which is essentially this forensic accounting techniques and procedures supercharged with data analytics. So we're not necessarily looking to see, we're not necessarily talking about like big unstructured data and data analytics from trying to detect certain things. We're actually using data analytics and data, and primarily structured data, to say what happened. So we've trademarked this phrase, data sleuth, to be forensic accounting plus data analytics to perform an investigation. And by identifying where did money come from and where did it go based on your bank statements, credit card statements, pay stubs, maybe some tax returns, there's different data sources we can pull from. We typically uncover hidden assets. So I have owned Workman Forensics for the last 10 years. And in 10 years, and I think I've worked somewhere around 200 cases, not all of divorce, but in all of these cases, if it has been a divorce case, I think there's only been one case where we didn't identify something hidden or unknown. And I do like to say that I don't really think that there is such a thing as a hidden asset. It's just that usually our clients don't know where to even start looking. So to them, it feels hidden. But when you know where to look and how to look, we can usually uncover that. So just like we would do that in a personal, like by looking at what are all of these personal things that you own, sometimes our clients, their spouses, or even themselves, they work in this family owned or closely held business. And in doing that, if you think about it, you're running this family owned, closely held business, and you know that whatever's reported as income at the end of the year, you're going to pay taxes on. So there's like this built-in incentive in just running a small business where you're going to take advantage of certain rules and just tax benefits to reduce your tax liability, right? And different structuring of companies and changing your year end, having different year ends and all these things to defer some of that revenue. Well, or recognizing that revenue for tax purposes. So in doing that, that might be beneficial for the family when everyone's together. But when you go into a divorce situation, that's making, that really works in the favor of the person who's been controlling the finances of the family, and not necessarily the person or the outspouse. And so we will often go in and look at, okay, what are the benefits that the owner has been taking that, while it might be fine for tax purposes, we're not weighing in on whether it's allowable or not, but just what are the things that whenever it's time to value this business, these things should have been considered a benefit to the owner and could impact that outcome. And I've got a good story later in the interview about that. So we help with that. And then sometimes when there's a prenup agreement or inheritance funds, that can actually make it where even though funds were all maybe in the same account, that really some of these funds can be separated. So maybe like one time somebody had some inheritance money and the husband did, and the wife didn't understand that inheritance money was his. And at least in the state of Oklahoma, that made it where what he used those funds on was his when it came time to separate the assets. And so sometimes we just trace those types of funds to be able to say, no, actually, this is his separate property or her separate property. And we do that with prenup agreements as well. And then lastly, we perform lifestyle analysis procedures to determine if income has been understated, which is important, especially with alimony. And mainly for us, we do it in child support cases.
Well, and I think what people don't understand, because valuations involve the balance sheet and income statement of a business, but a lot of times that could be reported on Schedule C on their personal tax return. And so I think that people don't conceptually understand that a lot of what we're doing in the business valuation is sanity checking it. Like, does this make sense? Does the tax return add up